It's interesting. When you buy a rental property, you tend to think long-term. Prices of houses don't change day to day or even necessarily month to month on a scale that it makes sense to buy and sell them anytime there's a change in value. If you purchased a rental property and suddenly a few more houses in the neighborhood sell for a much higher price in the very near future, your house likely just went up in value quite a bit, but you don't know it. And even if you did, if you were to turn around and sell it right away, there's a lot of cost to incur. So we don't even think about that. We just think we're going to collect this rent for the next 30 years. It's going to pay the mortgage back. That's the investment thesis on our rental property. Now, maybe a few years down the road, something changes, you cash out, you scale up, you reduce your portfolio, whatever the situation is, but it's not something that tends to happen very quickly. We think long-term. With stocks, it's different. The price changes drastically day to day. So it's important to think about what is our overall strategy when we're getting into a trade. We definitely want to adjust with the market because the cost to get in and out is basically nothing, unlike with real estate, and we can see what the values are. But Nvidia is a roller coaster ride, and you're going to tear your hair out if you're constantly trying to play the ups and downs of this market. In this video, we're going to update you. We bought a poor man's covered call about 40 days ago in order to sell premium, collect the rent on those shares. Nvidia happened to go up and down and up and down, but it didn't really change our underlying thesis. Let's see where things are at now. A quick recap. We purchased a long call option expiring January 25th, 2027 at the 85 strike price for $5,420 with the idea that we're going to sell premium each week. We will hopefully be able to take advantage of a long-term upward movement in the price. Little did we know, it spiked up almost immediately. We found ourselves up basically $1,000 on the underlying, and it was threatening to outrun our covered calls. So our opportunity to continue collecting premium on it each week was basically going away because we made all of the money really quickly. But it felt like there was more upside to come. So we didn't want to get out of the trade. And we didn't. We continued to sell premium. We made a bunch of moves here around earnings, some good, some bad. Ultimately, Nvidia came way down after earnings, and we gave all of those paper profits back. The unrealized gains that we had on the original position, all gone as of today. But we've continued to make trades and collect our premium. Now, we've been trying to manage it a bit, and one of the mistakes that I've made throughout this time is thinking that it's gonna pop up at any given moment, and I'm afraid that it's gonna run through my strike price and I won't be able to catch it. Like what happened before earnings. Turns out I didn't need to worry about that. I needed to worry about it continuing to come down. If I hadn't worried about it going up so much, we would have been in a better position. We would have made more money had we planned for a drop in the price or a hold flat. You can see all the different trades we've made throughout the last week. Ultimately, where we're at currently, we've received a total of $661 in premiums. This is what it looks like each week, what we've collected. This is a percentage compared to the cost of that original leaps. So the first week, we collected 4% premium. That's pretty good. 1.5 almost the next week, a little less than 1. Then we lost a little bit. This is our only bad week. And then we're back up to 2.5, and now we're back up to 4. So we're not doing too bad. Over the course of the last 40 days, we've recouped 12.2% of the cost of that leaps. That doesn't expire for nearly 2 years. As an average, that's about 2% per week. We can deal with that. Looking at that average, we need another 49 weeks to recoup the cost of that leaps, and then it's all profit. Assuming that leaps isn't worth anything. I mean, whatever it's worth at that point, it's all profit, plus the premium we can continue to receive week after week. If we decide to keep it that long, we may or may not. We're definitely going to try to do a better job of protecting our downside moving forward, especially as it ratchets up. Now, this was the beginning of the week. Last week, we sold the 130 strike for $130. Nvidia had a little bit of a drop that day after we did that, and we used it to buy a debit spread to the upside, trying to protect our upside. Turns out we didn't need it. It ended up expiring worthless this week. Soon as next week rolled around, Nvidia dropped quite a bit. You can see this was the stock price on that day. So we lost $10 per share. Due to that, we ended up buying this one back at some point throughout the day. We sold another one lower in strike price, and to protect our upside, we bought another debit spread. So we used some of the profits here to buy that. This was where we should have been protecting our downside more instead of with this. But again, the biases to the upside, I made the mistake of having a bias to the upside, thinking that it's going to continue to pop back up at any moment. Well, shortly after that, I decided to close both of these because it kept dropping. And then as a hedge, we just sold a little spread. I wanted to leave room for the upside because it felt like during that day, Nvidia could continue to go back up. So I wanted to collect a little bit of premium just in case it didn't. That's what this play was. But it would essentially leave all of the upside available except for potentially $100 between the 121 and the 122 strike price. The next day, Nvidia did go up a little bit. We ended up selling a ratio spread. The idea being we get some premium here, and if Nvidia goes down, we get to keep the premium. And if it goes up, if it gets close to this point, we profit. We make money because these two go up faster than this one does. And I can close that, and our long call gets to keep all of the increased gains. Well, that didn't work out. We ended up closing it, opting instead to sell the 119. And as it moved throughout the day, we made some other moves. We bought it back, used some of that profit to buy this spread, and we stayed uncovered overnight. So the next day, it did start and closed at a higher number, and we ended up selling the 118. So we went from the 119 down to the 118. We still had this open. You can see big drop that next day. We bought this one back, entered into some other spreads. It was basically a hectic week trying to manage this trade. Now, generally, with a poor man's covered call, you don't need to do this much management. You're just going to set your position at the beginning of the week, check in next week. You don't have to do a whole lot. But because I'm in front of the computer and I can manage it during the day, we tend to do a lot more trades than might be necessary. Now, ultimately, it did pay off for us making all of these individual trades. Had we just left this position throughout the week, we would have made $130. As it turns out, with the trades that we made, we were able to bring it up to $224 that we were able to collect on the week. So ultimately, we're not in a bad position. And moving into next week, we're currently sitting on a sold call at 115. We used that sold call to buy a put debit spread, trying to protect my downside a little bit now. And I'll tell you why. Here's the Nvidia chart. Nvidia not looking good here. This was the last week. This was earnings. This was after earnings. Not doing so hot. Didn't really push up at all. Now, we do have a hammer candle here. But as soon as we got through this line here, there was a risk that it could come all the way down to 102. That risk is still there. We pushed under this resistance level twice. There's a good chance it could come down to the 102. And if we go out on a bigger time frame, if it fails that one, we're down to 90. We're getting really close to where our call option is at. Our long call option is at the 85 strike. We've also got a lot of trades that happened in this range here. That was why we chose the 85 strike for our leaps. We should be able to manage this and continue collecting premium, even if it makes it all the way down to here. Hopefully we'll protect our downside enough that we're not going to really get in trouble. And at worst, we can get out of this for almost break even. Where we're at right now, our long call is worth $4,710 if we were to close it today. This is our break even right here. We're only slightly down. That's okay. We're not in a bad position overall on this trade. We've collected enough premium to offset the losses we've experienced. The current share price is below where we got into it 40 days ago, but we don't need to panic. The reason we got into this trade is because we don't know if the stock's going to go up or down. And the idea is we're going to collect that rent week after week after week. If we can do that for the next 2 years, that call option could be worth $0 and we could have a profitable trade. So even though we didn't sell and lock in all of our profits when we were up $1,000, it's not the end of the world because our long-term perspective on this was to sell premium each week, and we're still doing that. Hopefully that makes sense. If you have any questions, leave them in the comment section below. If you want to check out my spreadsheet, you can join our Discord by becoming a channel member. It's as little as $1 a month, and that gives you access to our Discord. This spreadsheet Any other spreadsheets that I'm keeping track of trades on will be in there. And of course, you can chat with me if you got questions. We just opened poor man's cover call in a Tesla position. Be sure to check out that video. The volatility from Tesla makes an incredible opportunity to rent out those shares like we're doing here. We collected $640 the first week. Now the cost of that leaps was 3 times as much as what we spent here. And you can see here, yeah, we got about 3 times as much, but we're protecting our upside better when we started that trade. Hopefully, because Tesla has nearly bottomed out, but we don't know. We will have to wait and see, but we have a really good opportunity, just like we do here, to continue collecting that premium. Now, as a reminder, I'm doing this inside of our retirement accounts, so I don't have to worry about taxes. If you're doing this outside of a retirement account, you're gonna need to take some of the profits and set them aside to pay taxes, so you don't get in trouble at the end of the year. Even though we could experience some losses, because these are long leaps, we're gonna be holding these for a couple of years. You're not gonna be able to recognize those losses due to the wash sale rule. Now, double check with your accountant on that, but if you just plan ahead and set aside some of this money to pay taxes, you should be okay. Now, my recommendation, when I'm trading in an after-tax brokerage account, when I need to set aside that money for taxes, I'm doing so inside of my high cash value life insurance. It's the best place to store cash when it's not being put to use and it's already earmarked for something else in the near term. If you want to know more about that, check out my comprehensive guide to infinite banking in the video right up here in the corner. With that, we'll see you next time. The next 20 seconds determine your future. Subscribe, meet with me, or continue educating yourself with these videos right over here. I appreciate you. Now go maximize your cash flow.